Right now, as we speak, Opendoor Technologies, ticker symbol OPEN, is trading at exactly $7.05 per share. The intraday action has been choppy, with the stock sliding roughly 2.50% since the opening bell, struggling to find its footing after testing a high of $7.12 earlier in the session. If you are watching the charts, you are seeing a classic battle between exhausted sellers and opportunistic buyers trying to defend the $7 level. The volume is ticking over 50 million shares, which is significant, but it feels tense. The market is waiting for a clear signal, and right now the price action is muddy. Here is where the tension lies between what you expect and what is actually happening. The expectation, the narrative you will hear if you casually browse headlines or listen to the average talking head, is that Opendoor is a zombie company. The prevailing belief is that iBuying is a failed experiment, a relic of the zero-interest rate environment that crashed and burned when Zillow and Redfin exited the space. Most investors look at Opendoor and see a company stuck in a house freeze, burdened with inventory it can't sell, destined to bleed cash until it fades into obscurity. They see a house flipper in a market where nobody is moving. That is the expectation. Here is the reality. Opendoor in late 2025 is not the same company it was in 2022. While everyone was writing obituaries for the iBuying model, Opendoor quietly underwent a massive internal restructuring that has fundamentally altered its DNA. The reality is that under the new leadership of CEO Kaz Nejatian, the former Shopify executive who took the reins, Opendoor has stopped trying to just flip houses and has started building the Amazon of real estate software layer that actually works. They are no longer just capital-intensive house buyers, they are becoming a capital-light marketplace. They have successfully shifted a massive chunk of their volume to their exclusives marketplace, where they connect buyers and sellers directly without ever taking the home onto their own balance sheet. This is the detail the bears are missing. The market is pricing Opendoor like a risky real estate hedge fund, but the internal metrics show it evolving into a high-margin software platform. This disconnect is where the opportunity and the danger lives. Let's look at the immediate context of this trading week. The stock has been on an absolute tear this year, up over 350% year-to-date in 2025. That is not a typo. If you looked away for 6 months, you missed a massive repricing event. This rally has been fueled by two things: a meme-style resurgence in retail interest and a very specific financial mechanism called the warrant dividend. Shareholders recently received a special dividend of tradable warrants, tickers OpenW, OpenL, and OpenZ. This was a complex financial engineering move that effectively allowed existing shareholders to leverage up on the company's future without putting in new capital. It created a frenzy of trading activity that we are still seeing ripple through the order books today. It forced short sellers, who were sitting on a massive 16.5% of the float, to reconsider their positions, creating a squeeze that sent the stock from the low single digits to where we sit now. But today's drop to $7.05 suggests that the initial euphoria of that dividend is wearing off, and now investors are forced to look at the fundamentals again. When we talk about Opendoor, we have to talk about the housing market's lock-in effect. This has been the single biggest headwind for the company. Mortgage rates spiked, and millions of Americans with 3% mortgages refused to sell. Inventory vanished. For a company that needs transaction volume to survive, this should have been a death sentence. However, Opendoor did something counterintuitive. Instead of chasing volume at any cost, they shrank. They cut their workforce significantly. We saw a 17% reduction just a few quarters ago. They separated their mainstay business unit to save $35 million annually. They discipline their buying criteria so aggressively that their contribution margin, the profit they make on each home after direct costs, actually stabilized even as volume dropped. This is the sign of a mature management team. A younger, more reckless Opendoor would have tried to grow through this downturn and blown up its balance sheet. The current Opendoor decided to hibernate and build software. Now, let's widen the lens to the broader market for a second. If you are sitting there with Tesla stock or Apple stock in your portfolio, you are used to companies that control their own destiny. Tesla cuts prices, demand goes up, Apple releases an iPhone, people line up. Real estate is different because Opendoor cannot force people to move. They are at the mercy of the Federal Reserve. But here's the twist. The Federal Reserve is signaling rate cuts. We've already seen the first moves, and the expectation for 2026 is a normalizing rate environment. If mortgage rates drop even to high 5% range, the lock-in effect breaks. The dam bursts. And when that inventory hits the market, who is the only institutional player left standing with the infrastructure to handle it? Zillow is gone. Redfin is gone. Opendoor is the last giant in the room. This monopoly on the instant offer product is incredibly valuable if the market turns. It's similar to how Fidelity or Schwab Intelligent portfolios dominate the online investment space, because they have the scale that smaller players can't match. When you want to invest online, you go to the platforms that have the liquidity and the trust. When a homeowner in 2026 wants to sell instantly, Opendoor is not just the best option. In many markets, it's the only option for that specific service. Let's break down the business model for those who might still think this is just flipping. Traditionally, Opendoor buys a home, fixes it, and sells it. That's the 1.0 model. It's capital-heavy and risky. If home prices drop 10% while they hold the asset, they lose millions. The 2.0 model, which they are aggressively pushing, is the marketplace. Here, a seller comes to Opendoor, and Opendoor says, "We will list this on our private marketplace for our network of institutional buyers." Hedge funds, rental giants, and smaller investors bid on the home. Opendoor takes a transaction fee, but never takes title to the home. They take zero market risk. This is the holy grail. It turns Opendoor from a real estate investor into a tech platform, like Robinhood or SoFi. Think about Robinhood stock trading. Robinhood does not buy the stocks itself, it just facilitates the trade and takes a cut or payment for order flow. Opendoor wants to be the Robinhood of homes. They want to be the pipe that liquidity flows through. If they pull this off, the valuation at $7.05 is laughable. Tech platforms trade at 10x revenue. Real estate flippers trade at 0.5x revenue. Opendoor is currently priced like a flipper. The bet you are making at this price is that they successfully transition to being a platform. But we must address the risks because they are substantial. The biggest risk is execution. The transition to a marketplace model is hard. You need buyers. Institutional buyers have pulled back significantly in the last 2 years. If Opendoor builds a marketplace and nobody shows up to bid, the model fails. The second risk is the debt. Opendoor has billions in non-recourse debt backed by the homes, but also substantial corporate debt. If the housing recovery is delayed until 2027, they could burn through their cash cushion. They have about $1.2 billion in total capital, which sounds like a lot, but in the low-margin world of real estate, it can evaporate quickly if spreads turn negative. We also have to talk about the meme factor. The recent rally to over $7 has attracted a lot of short-term speculative capital. These are not long-term believers. These are traders looking for a squeeze. If the stock drops below $6.50, we could see a cascade of selling as these traders bail out. This creates volatility that has nothing to do with the business fundamentals. Comment below, do you think the housing market will actually unfreeze in 2026? Or are high rates here to stay for another decade? I want to hear your take on the macro picture, because that's the wind in Opendoor's sails. Let's look at the competitive landscape. You have the traditional route, hiring a real estate agent, staging the home, and waiting. This is Opendoor's biggest competitor. The National Association of Realtors Settlement recently changed the game by altering how buyer-agent commissions are paid. This has created confusion in the market, which actually benefits Opendoor. Opendoor's model is transparent. Here is the price, here is the fee. In a world where traditional agent fees are becoming complex and negotiated, Opendoor's simplicity is a massive asset. Then you have the legacy tech players. Zillow is now focusing on being